I want you to picture two people, same age, same income, same starting point. The first one is Daniel. Daniel reads finance Twitter every morning before he is even out of bed. He has a Robinhood account, a Coinbase account, a Weibo account, and a stack of stock-picking newsletters cluttering his email. He buys NVIDIA at the top because he saw a chart on a Discord server. He panic sells in March 2020 when the market drops 34% in 5 weeks. He jumps into meme stocks during the GameStop frenzy. He spends roughly 4 hours every weekend rebalancing what he calls his portfolio. Over 25 years, Daniel watches CNBC during his lunch break, listens to dozens of podcasts on his commute, and personally executes over 6,000 trades. The second one is Karen. Karen sets up one brokerage account at Fidelity in her late 20s on a Sunday afternoon while drinking coffee in her kitchen. She puts $10,000 into a single index fund, sets up a small automatic transfer of $100 on the 15th of every month, and then does nothing. She does not check the balance. She does not watch market news. When CNBC anchors are screaming about an imminent crash, Karen is at her kid's soccer game. When Bitcoin doubles and her brother-in-law tells her she is missing out at Thanksgiving dinner, Karen is reading a novel by the window. The brokerage app sits in a folder on the third screen of her phone, and she opens it maybe twice a year. When they both turn 65 and finally compare statements at a casual dinner, Karen has roughly $400,000 from that one initial decision, plus the small monthly contributions. Daniel has a fraction of that, plus a stack of regret and 1,000 brokerage statements. He worked harder. She got further. That is exactly what the math predicts, and it has predicted the same outcome for every Karen and every Daniel for the last 100 years. There is no luck in any of this. There is no market timing, no genius stock pick, no early bet on a hot trend. The story is about the hidden relationship between effort and investment returns that almost nobody understands until it is too late. Today, I am going to walk you through the laziest legitimate path to growing $10,000 into $400,000, the actual math behind why doing less wins, and the specific accounts, expense ratios, and contribution limits that apply right now in 2026. By the end, you will understand why one of the wealthiest investors in modern history, Warren Buffett, told the trustees of his estate to put his wife's inheritance into a single low-cost S&P 500 index fund and leave it alone forever. Let's start with the part that feels too good to be true. The math behind turning 10,000 into 400,000 is the same math written on the chalkboard of every introductory finance class on earth. It is called compound interest, and it is the only force in finance that gets stronger the less you touch it. The S&P 500, which tracks the largest 500 publicly traded companies in the United States, has produced an average annual return of roughly 10% per year over the last 100 years. Over the last 20 years, ending early 2026, the index averaged 11.8% annually, with dividends reinvested. Adjusted for inflation, the long-run real return drops closer to 7%. The number moves a little depending on which decades you include, but the long-run average sits very close to 10% in nominal terms, and most financial planners use that number as the standard projection. If you take $10,000 and let it grow at 10% per year, here is what actually happens year by year with no additional contributions of any kind. After 10 years, you have roughly $25,900. After 20 years, $67,300. After 30 years, $174,500. After 39 years, $411,400. After 40 years, $452,500. You did nothing. You added no money beyond the initial $10,000. You made no decisions. The $10,000 sat in a single index fund inside a brokerage account. The dividends got reinvested automatically, and the math did the rest. This is what the rule of 72 is trying to tell you. Take 72, divide by your annual return, and you get the number of years it takes for your money to double. At 10%, money doubles every 7.2 years. So 10,000 becomes 20,000 in about 7 years, then 40,000, then 80,000, then 160,000, then 320,000. By year 42, you cross 640,000. Each doubling is bigger in absolute dollars than all the previous doublings combined. The first doubling adds 10,000. The fifth doubling adds 160,000. That is what people mean when they say compounding is exponential, not linear. The first 10 years feel slow and disappointing. You put in 10,000, watch it crawl, and start to wonder if any of this is real. The last 10 years feel almost unfair. The chart goes from a flat line to a vertical wall, and you did not do anything different. You just stayed in your seat through every recession, every election cycle, every panic. Now imagine the version of this where you do not just put in 10,000 and walk away. You also automate a small amount each month into the same account. Even $100 a month, which is roughly the cost of one nice dinner per month for a couple, changes the math significantly. Over 39 years at the historical 10% return, that $100 a month turns into another $600,000 on top of the $400,000 from your initial deposit. The total balance crosses $1 million. Bump the monthly contribution to $200, and the total balance crosses $1.5 million. Bump it to $500, and you are looking at well over $3 million. None of this requires a finance degree or the Wall Street Journal on your kitchen table every morning. It requires you to set up the automation once, leave it alone, and let time do what time does. So here is the obvious question. If the math is this clean and this well documented, why does almost nobody pull it off? Why is the average American household near retirement age sitting on a small fraction of what compounding could have produced for them? According to recent Federal Reserve data, the median 401k balance for Americans aged 55 to 64 is around $71,000. The average is much higher, but that average is dragged up by the small minority who actually executed this strategy. The median is the middle person, and the middle person is nowhere near 400,000. The answer comes in two parts. The first is that most never understand what an index fund actually is, so they never use one. They keep their money in a savings account, earning 4% if they are lucky, or they pick individual stocks based on news headlines, or they pay an advisor to do something fancy that performs worse than the index. The second part is that the people who do use index funds get scared out at exactly the wrong moments. They sell during downturns. They stop their automatic contributions when money gets tight. They borrow against their 401k for a kitchen renovation. We are going to fix both of those problems. Let's start with the engine itself. An index fund is a basket. That is the entire concept. Instead of trying to pick the next NVIDIA or Tesla or whatever the hot stock of the moment is, you buy a single fund that holds tiny pieces of every large company in America at once. The Vanguard Total Stock Market ETF, ticker VTI, holds shares of more than 3,000 U.S. companies. The Vanguard S&P 500 ETF, ticker VOU, holds the largest 500. The Fidelity Zero Total Market Index, ticker FZROX, does roughly the same thing as VTI. When Apple goes up, your fund goes up. When some random small-cap drug company collapses to zero, your fund barely notices because it was less than 0.1% of the basket. You own the whole field, so you cannot lose to the field. The reason this matters is that nobody, not your uncle who watches Mad Money, not the guy with the YouTube channel and the gold backdrop, not the hedge fund manager wearing a Patagonia vest in the glass office on Wall Street, can reliably pick which individual stocks will win over decades. The data on this is not subtle. It is screaming. The S&P Dow Jones Indices Group publishes a report called SPIVA, which stands for S&P Indices versus Active. They have been tracking how active fund managers perform against the basic index for over 20 years. Their most recent 20-year scorecard, covering 2005 through 2024, shows that 94.1% of all domestic U.S. active funds underperformed the simple index. On a risk-adjusted basis, accounting for how much volatility they took on to get those returns, that number rises to 97.3%. Out of 18 domestic fund categories tracked, In only 2 categories did less than 90% of the funds underperform their benchmark. Over 15 years, more than 90% of U.S. large-cap active equity funds lag the S&P 500. These are professional money managers. They have Bloomberg terminals on their desks, teams of analysts crunching financial reports, expensive Manhattan office space, and Ivy League resumes. They charge their clients somewhere between 0.5% and 1% every single year. And 9 out of 10 of them lose to a robot that just buys everything and never trades. It gets even worse when you stretch the time horizon. The longer the comparison window, the worse the active managers do. Less than half of the active funds even survive the full 20-year period. Many quietly closed their doors or merged with other funds because their performance was too embarrassing to keep displaying. The funds that did beat the index in any given year usually did not repeat the next year. The S&P 2024 Persistence Scorecard found that picking last year's winners was no better than picking funds at random. Warren Buffett, who is widely considered the greatest investor alive, made a famous bet about this in 2007. He wagered $1 million that a basic Vanguard S&P 500 index fund would beat any basket of 5 hedge funds a competitor could pick over the following 10 years. The hedge fund firm Protégé Partners took the bet. 10 years later, in 2017, the index fund had returned more than 125%. The hedge funds returned around 36%. Buffett gave the winnings to charity and wrote about the bet in his annual letter to Berkshire Hathaway shareholders, repeating his standard advice: just buy the low-cost index fund and stop looking for shortcuts. In his 2013 letter, Buffett wrote that when he dies, his trustees should put 90% of the cash he leaves his wife into a low-cost S&P 500 index fund and 10% into short-term government bonds. He believes that simple 2-fund portfolio will outperform almost any complicated strategy a financial advisor could build. The richest investor of his generation recommends an index fund. That should tell you everything. So why does the index win? 2 reasons, and both come back to laziness. The first reason is fees. Active funds charge somewhere between 0.5 and 1.5% of your balance every single year, regardless of whether they made or lost money for you. Index funds charge between 0.03% and 0. Fidelity introduced a fund a few years ago called FZRO, the Fidelity Zero Total Market Index Fund, with an expense ratio of literally 0%. The Vanguard Total Stock Market Index Fund, ticker VTSAX, charges 0.04%. The ETF version, VTI, charges 0.03. Schwab Total Stock Market, SWTSX, runs at 0.03. These fees are essentially rounding errors compared to active funds. That fee gap looks tiny on paper. It is murderous over time. Let me show you exactly. Take $10,000 and grow it at 10% for 40 years inside an index fund charging 0.03% in fees. You end with roughly $447,000. Take the same $10,000 at 10% inside an actively managed fund charging 1% in fees. You end with $314,000, same starting amount, same time horizon, same market exposure. The single percent difference in fees cost you $133,000. That is more than 13 times your original investment, lost to fees for a fund that statistically underperformed the index anyway. The second reason index funds win is human behavior. An active fund manager has to do something. That is what their clients pay them for. So they trade. They sell at the wrong time. They miss the best 10 days of the year because they were temporarily in cash trying to time a pullback that never came. Studies have shown that missing the 10 best days of the market over a 30-year period can cut your final balance roughly in half. Active managers underperform partly because their structure forces them to trade, and partly because, like everyone else, they are human, and humans are bad at staying calm during scary headlines. An index fund cannot panic. An index fund cannot read Reddit threads about the impending recession. An index fund just keeps owning everything, year after year, and the math grinds on. This is the laziest part of the laziest strategy. You buy the basket and you do not touch it, ever. Not when the market drops 30%. Not when your coworker tells you to switch to Bitcoin. Not when a financial influencer says the top is in. You leave it alone and you let compounding do the work that nobody else can do for you. But buying the right basket is only half the puzzle. The other half is buying it inside the right account. And in the United States in 2026, the account you choose can save you tens of thousands of dollars in taxes or cost you exactly that much if you choose wrong. Here is how the lazy account stack works in 2026. The first account in the stack is your employer 401k, and the only thing that matters at this stage is the match. If your company matches a percentage of your contributions, that is a 100% immediate return on your money. Nothing else in personal finance comes close. If your employer matches up to 4% of your salary, you put in 4%, period. Skipping the match is the financial equivalent of finding $20 bills in your driveway and walking past them every morning on the way to your car. The 2026 contribution limit for a 401k is $24,500 for workers under 50. For workers 50 and older, you can add a standard catch-up contribution of $8,000, bringing the total to $32,500. There is also a special boosted catch-up under a Secure 2.0 for workers age 60 through 63, which raises the catch-up to $11,250. One important new rule for 2026, if you earn more than $150,000 in FICA wages, your catch-up contributions must now be made on a Roth basis, meaning, after tax, most workers are not anywhere near these limits, which is fine. Just capture the match first. A 401k gives you a tax deduction in the year you contribute, your money grows tax-deferred, and you pay ordinary income taxes when you withdraw in retirement. If your employer offers a Roth 401k option, you contribute after-tax dollars instead, and your retirement withdrawals come out tax-free. Younger and lower-earning workers generally benefit more from the Roth version. The second account in the lazy stack is the Roth IRA. This account is the favorite of almost every serious financial planner in America for a reason. You put in money you have already paid taxes on. It grows tax-free. You pull it out tax-free in retirement after age 59 and a half. Your contributions, but not your earnings, can be withdrawn at any time without taxes or penalties. The 2026 contribution limit is $7,500 or $8,600 for people 50 and older. There is an income limit on Roth IRA contributions you have to understand. For single filers in 2026, the full contribution is allowed up to $153,000 of modified adjusted gross income, with the phase-out running to $168,000. For married couples filing jointly, the full contribution is allowed up to $242,000, with the phase-out running to $252,000. If you are above the income limits, there is a workaround called the backdoor Roth IRA, where you contribute to a traditional IRA without taking a deduction. Then convert that money to a Roth. The third account, and one of the most underrated tools in the entire U.S. tax code, is the Health Savings Account, or HSA. You can only contribute to one if you are enrolled in a high-deductible health insurance plan. But if you do qualify, the HSA is the only account in America with 3 layers of tax benefits. Your contributions are pre-tax. Your investments grow tax-free, and withdrawals for qualified medical expenses are also tax-free. After age 65, you can pull the money out for any purpose at all, and it works essentially like a traditional IRA, with ordinary income taxes due on non-medical withdrawals, but no penalty. For 2026, the HSA limit is $4,400 for individuals and $8,750 for families. Almost everyone who has an HSA available treats it like a checking account for medical bills, which misses the entire point. The HSA is a stealth retirement account if you can afford to pay your current medical bills out of pocket. The lazy strategy is to invest your HSA contributions in an index fund inside the account, save your medical receipts, and let the money compound for 30 years before you ever touch it. After 30 years of compounding, that account can be worth hundreds of thousands of dollars, and you can use the saved receipts to take tax-free withdrawals whenever you want. The fourth account is the regular taxable brokerage. This is just a normal investment account at Fidelity, Vanguard, or Charles Schwab. You can deposit any amount, no income limits, no contribution limits, no rules about when you can withdraw. The trade-off is that you pay capital gains taxes on profits when you sell, and you pay taxes annually on dividends. This is the bucket for whatever is left over after you have filled the tax-advantaged accounts above. The lazy order of operations looks like this. First, contribute to the 401k up to the full employer match. Second, max out an HSA if you qualify. Third, max out a Roth IRA if your income allows. Fourth, keep contributing to the 401k up to the full annual limit. Fifth, anything left over goes into a regular taxable brokerage. That is the entire framework. There is no step 6, no Bitcoin mining rig, no overseas tax shelter, no real estate syndication. Notice what is not on this list. No day trading, no leveraged options, no crypto, no real estate flipping, no individual stock picking. The lazy stack does not need any of those things to turn 10,000 into 400,000. It just needs time and discipline. People who skip the Roth IRA and the HSA and dump everything into a taxable account often end up with 30 to 40% less wealth at retirement, even with the exact same investment returns, simply because the IRS took a slice every step of the way. If you are getting value from this so far, hit the subscribe button before you forget. I post a new finance video every week. The goal is always the same: cut through the noise and tell you what actually moves the needle. Now, let's talk about the part of the lazy strategy that is the single hardest piece. The math is not the hard part. Picking the account is not the hard part. The hard part is the automation and specifically the discipline to set it up correctly the first time and then never undo it. Automation is what turns the lazy strategy from theory into reality. Every modern brokerage, including Fidelity, Vanguard, Schwab, E-Trade, and Robinhood, lets you set up an automatic monthly transfer from your checking account directly into a chosen fund. You pick the day of the month and the dollar amount once, and the transfer happens forever after. Whether you remembered or not, whether the market is up or down, whether the news is good or terrifying. This is called dollar cost averaging, and it has two giant advantages over trying to time the market. First, it removes the emotional component entirely. You will never have to wonder if today is a good day to invest. The decision is already made by past you, and present you does not get a vote. People who try to time the market with their contributions almost always end up with worse outcomes than people who just put the money in mechanically every month. Second, when prices fall, your automatic transfer buys more shares for the same dollar amount. When prices rise, it buys fewer shares. Over decades, you accumulate a low average cost without ever having to think about it. You are essentially being forced to buy more when stocks are on sale and less when they are expensive. This is the opposite of what humans do when left to their own emotional devices. The S&P 500 has produced its long-run 10% annualized return despite some genuinely brutal stretches. There was the dot-com crash from 2000 through 2002, where the index lost roughly half of its value. There was the 2008 financial crisis, where the index dropped 56% from peak to trough. There was the COVID crash in March 2020, where the market dropped 34% in 5 weeks. Every single one of those moments looked like the end of the world to people watching CNBC at the time. Headlines screamed about new normals, paradigm shifts, and the end of capitalism as we know it. In every single one of those moments, the lazy investor who automated their contributions and ignored the news was quietly buying shares at deep discounts. The famous example is March 2009. The S&P 500 closed at 676 points on March 9th of that year, the lowest close of the financial crisis. As of early 2026, the index is trading above 7,000 points. That is a return of roughly 10 times in 17 years for anyone who simply held on through the panic. But the people who held on were a tiny minority. The majority sold somewhere on the way down. They watched their balance drop from 100 to 70,000 to 50,000 and finally cracked. They moved their money to cash near the bottom and never bought back in time. By the time they were emotionally ready to invest again, the market had already recovered most of its losses. Studies of investor behavior during the 2008 crisis showed that people who sold during the downturn returns than people who simply did nothing. This is the behavioral trap that destroys the lazy strategy. The math works perfectly. The accounts are available to anyone with a social security number. The fees are essentially zero. And then a person opens their phone, sees a red number, panics, and undoes a decade of patient accumulation in 15 minutes. There is a simple defense against this trap, and it is genuinely lazy. Stop checking. Most successful long-term investors check their portfolios once a quarter or even once a year. They do not have a brokerage app on the home screen of their phone. They do not turn on financial news. They do not have a friend who calls them every time the Dow drops 200 points. The act of monitoring your investments more often produces no return. It only increases your odds of doing something stupid based on a temporary market move. Behavioral economists have actually studied this phenomenon. Research firm Vanguard ran a study they called behavioral coaching and found that investors who avoid emotional reactions during downturns earn roughly 1.5% more per year over time, just from not panicking. That seems small until you compound it over 40 years. 1.5% compounded over 40 years is the difference between 400,000 and over 700,000. The single most valuable financial skill in your life might be the ability to do nothing during scary times. Charles Schwab found something similar in their internal data. The investors with the best long-term returns in their database fell into two specific groups. The first was people who had simply forgotten they had an account. The second was people who had died and the heirs had not yet claimed the assets. Doing nothing literally beat doing something. The accounts that earned the most were the ones where nobody touched the buttons. So here's the lazy automation framework. In plain language, set up the brokerage account at Fidelity, Vanguard, or Schwab. Open the right tax-advantaged accounts inside that brokerage. Pick the fund. Schedule the automatic transfer for whatever amount fits your budget. Move the brokerage app to a folder you never open. Go live your life. Check it once a year if you need to feel something. Otherwise, just let it run. Which brings us to the actual portfolio. What do you put the money in? In 2026, you really only need to know two options: the one fund option and the three fund option. Both are lazy. Both work. Both outperform the vast majority of more complicated strategies over long time horizons. The one fund option is called a target date fund. You pick the year you plan to retire, find the corresponding fund, and buy it. If you are 35 right now and plan to retire around 65, you would buy a 2055 or 2060 target date fund. The fund automatically holds a mix of U.S. stocks, international stocks, and bonds, and it slowly shifts toward more bonds and less stocks as you get closer to retirement. You do nothing. The fund manager rebalances for you. The major brands here are Vanguard's Target Retirement Series, Fidelity Freedom Index Funds, and Schwab Target Index Funds. Average expense ratios for index-based target date funds are around 0.1 to 0.15%. The actively managed versions are higher, around 0.3% on average. Stick with the index versions, which usually have the word index in the fund name. The major argument against target date funds is that they include international stocks and bonds, which over the last 15 years have underperformed pure U.S. stocks. The major argument for them is that nobody knows what will outperform over the next 40 years. There were entire decades, like the 2000s, when the S&P 500 had near zero returns while international stocks did fine. Target date funds protect against that scenario without you having to think about it. The three-fund option, popularized by the Bogleheads community of devoted Vanguard followers, is slightly more hands-on, but still extremely lazy. You buy three funds. One is a U.S. total stock market fund like VTI, VTSAX, or FSROX. One is an international stock fund like Vanguard's VXUS or Fidelity's FZILX. One is a U.S. bond fund like BND or FXNAX. You decide on a percentage split, often something like 60% U.S. stocks, 30% international, and 10% bonds for someone in their 30s. You rebalance once a year by selling whichever fund grew the most and buying more of whichever lagged. The reason you might prefer 3 funds over a target date fund is slightly lower fees and more control over the international and bond percentages. The reason you might prefer the target date fund is that you literally do not have to think about anything ever. Both will get you to $400,000 over the long run if you actually leave them alone. Forget about leveraged ETFs, sector funds, gold and commodities, and whatever your brokerage is currently advertising on the homepage. The marketing is designed to get you to do something because brokerages make more money when you trade. The lazy strategy is to do nothing. The actual buttons to click look like this. You go to Fidelity.com, Vanguard.com, or Schwab.com. You open a Roth IRA. The application takes about 10 minutes online and asks for your social security number, your bank account information, and a few simple employment questions. Once the account is open, you transfer your money in via a standard bank transfer, which usually takes 1 to 3 business days. Then you go to the trade screen, type in the ticker of your chosen fund, click Buy, and confirm. That is the entire process. People who put this off for years often do so because they assume it must be more complicated than that. It is genuinely a 10-minute task to set up a wealth-building machine that runs in the background for the next 40 years. If you have less than $10,000 to start, do not let that stop you. Most brokerages now allow you to buy fractional shares, which means you can put in $50 or $100 and still own a sliver of an index fund. The math works the same way at smaller scales. $5,000 at 10% for 40 years still becomes over $225,000. Even a few $100s compounded for a few decades is meaningful, and the habit of contributing matters more than the starting amount. So now you have the math, you have the engine, you have the accounts, you have the portfolio, you have the automation. The lazy strategy is fully on the table, with no missing pieces. There is one last thing I have to tell you, because without it, everything you just learned is technically useless. The lazy strategy fails for one specific reason, and that reason is responsible for almost every personal finance disappointment story you have ever heard. The lazy strategy assumes you have $10,000 to invest in the first place. It assumes you have the income margin to add $100 a month in automation. It assumes you can keep your hands off the account when life punches you in the mouth. And almost everyone underestimates how many financial traps stand between them and that first $10,000, and how many more traps stand between them and leaving it alone for 39 years. Look at where the average American actually ends up. According to recent Federal Reserve data, the median retirement balance for households approaching retirement is well under $400,000. About 40% of Americans aged 55 to 64 have less than $50,000 in retirement savings. The math we just walked through is not unknown. It is in every personal finance book ever written. So why does almost nobody pull it off? Because the lazy strategy is constantly under attack from non-lazy decisions in every other area of life. The $700 car payment that everyone tells you is normal, the mortgage you got pre-approved for that consumes nearly half your take-home pay, the child care bill that hits $17,000 a year per kid, the lifestyle creep where every raise dissolves into nicer dinners and a gym membership you do not use, the credit card balances that snowball quietly, the home renovation that was supposed to cost $40,000 and ended up at $90,000, the investment property that drained your savings before it generated a single dollar. Each of these traps is shaped to look like a responsible adult decision in the moment. Each one is sized perfectly to siphon off the money that was supposed to go into the lazy machine. The reason a typical 35-year-old in America has barely any retirement savings is not that they failed to learn what an index fund is. They are failing because by the time they sat down to start investing, half of their income was already committed to traps that looked like progress. This is the part of personal finance that almost nobody talks about clearly enough. The lazy investing strategy is the simple part. Avoiding the wealth traps that ambush you at every age, that is the actual hard work. Knowing what an index fund is takes about 30 seconds. Knowing which financial decisions in your 20s, 30s, 40s, 50s, and 60s will quietly destroy compounding before it ever starts, that is the foundation everything else gets built on. If you have not yet sat down and audited which traps are currently active in your own life, doing that audit is the most valuable hour of work you can do this month. There is a full breakdown of every financial trap by age right here on this channel. And honestly, if you are at the start of a real money journey, that video is the one to watch before you do anything else. The lazy strategy in this video is the destination. Avoiding the traps is the road. Let me bring this all the way home before I let you go. The laziest legitimate way to turn $10,000 into $400,000 is exactly what Karen did at the start of this video. Open one brokerage account, pick a single low-cost index fund or target date fund, use the right tax-advantaged account in the right order. Automate a small monthly contribution. Do not check the balance more than once a year. Wait roughly 40 years. The S&P 500 has done the rest of the work for any patient investor for the last 100 years. Daniel, the active version, is statistically very likely to lose to Karen, the lazy version. The SPIVA data is brutal on this point. So is Buffett. So is your own behavior over time. Doing more does not produce more. In long-term investing, doing less is the strategy. The only thing that can break this for you is the slow leak of money into traps that never get audited, the car you cannot really afford, the house you stretched to buy, the lifestyle you adopted because everyone around you adopted it first. Plug those leaks first, and the lazy machine quietly mints wealth in the background. Hit subscribe if any of this clicked for you. Every video on this channel is built around the same idea. Stop overcomplicating money. The math is on your side. The system is already built. You just have to step into it and stop interrupting it. I will see you in the next one.